Constructing your life is about much more than just building a bank account. Each week, join real estate entrepreneur and mindset coach Austin Linney as he interviews guests who are constructing their dream lives and impacting the world around them on a daily basis. If you're an entrepreneur or wanting to start a business, or you just want to hear motivating stories of how others have overcome the odds, you are in the right place. And now for your host, Austin Linney.
Guys, welcome back to Construct Your Life. This is Austin Linney here. I have the honor of having Mr. Neil Wahlgren here, right? I got it right?
That's right. Yeah, I'm happy to be here. Thank you.
Thank you. Before we get started, I want to thank our sponsor, Adam Carswell over at dreamchasers.com. Thank you so much. But what I like to do with my guests, Neil, is I like to let them tell the story where they want to, and then we'll just kind of get rolling from there.
That sounds great. Yeah, I'll tell you a little maybe about kind of the how I got here, and then we can just take it from there if that works.
Sounds great.
Okay. Yeah. So I'm a California native, born and raised outside of San Francisco, out in the burbs there. I was looking for a little excitement. So I ended up getting my undergrad out in the Air Force Academy out in Colorado, and ended up having, I would say, a slightly unusual track for someone who ends up in real estate, but ended up flying jets for the Air Force for about 8 or 9 years, the C-130 Hercules. So got to go travel the world, carry a lot of stuff, see a lot of places, 2 combat deployments, Iraq and Afghanistan, along with, I think my current country counts just shy of 100. I think I'm at 98 or 99. So depends who's asking. But
so no, before, because I'm a travel geek.
Okay.
Favorite country.
Oh man, there's been some great ones. I would say one of my favorite surprises was Kyrgyzstan, and
where is that?
Yeah, right. Good question. It's a former Soviet bloc country just south of Russia. Next to Kazakhstan and next to Afghanistan, kind of tucked up there in that, southeast Asia area, I guess you could say.
I love it.
So, yeah, but there's a lot of surprises out there when you actually get off the beaten path. But, I still love the, the go-tos, Italy and, Cambodia is a lot of fun. Colombia, I'm missing it right now with the whole COVID restrictions.
Yeah.
But yeah, so anyway, I did that for a bit, about 8 or 9 years, and then ended up having the opportunity to kind of transfer over to the Navy Reserve. They had bases all right on the coast instead of, in hotter, drier areas. So I've always been, a bit of a beach guy myself. So ended up moving down to SoCal, was flying part-time with the Navy, and I ended up getting my MBA with Texas A&M on the way. And that was kind of my first plug-in to, quote unquote, civilian life, and ended up getting a job with a renewable energy startup. And it was really, really fun. Got to work with a bunch of engineers on a project management job early on, and then eventually kind of transitioned over to business development and found I really kind of liked the entrepreneurial side. We actually created this biocarbon product, and not only were we trying to say, hey, can we sell this? Who do we sell it to? How much do we think we can get for it? What kind of data do we need to, basically support our valuation? And we were taking this to farmers, commercial growers, soil blenders, horticulturists, all sorts. And I really found that it was exciting to me in a way that, really I didn't think, civilian non-flying work could be. And, I think that kind of that early taste for it was what ultimately drove me to, transition over to real estate. So I had an opportunity to move back up to the Bay Area into San Francisco about 6 years ago. And a family friend had started a company for about 10 years prior. And it was an equity company where his focus was strictly on building a network of investors and kind of the marketing that goes with it, to basically pool together capital and invest in commercial real estate projects. So we were not operators. We were simply the equity focused arm, and we would actually JV on a project by project basis with either developers or commercial real estate brokers that had access to good deals, could put together, a great real estate project, but lacked the access to capital. So we would come together in a way that was, win-win for both sides. and then see that through start to finish on each project. So, but yeah, it was a neat kind of transition over there. And in that role, we actually had about 6 or 7 operators, all with different, really, kind of in the weeds focus, right? We had one group that only did multifamily up in northeast Atlanta, 1990s build. We had another group that loved doing multi-tenant retail in the Dallas-Fort Worth area. Another one who did, land entitlement and senior assisted living developments up in Northern California. And these were, each of these had their expertise and their focus. And it was neat because I got to, really on the partnership level, deep dive into their underwriting, deep dive into the business model, and really see a bunch of different types of commercial real estate. And one of these operators that we partnered with, and we raised money for about 3 or 4 deals back in 2017, was a group called Mag Capital Partners. And their specialty was single tenant net lease and largely industrial. And I really enjoyed the model. I enjoyed the simplicity. And I enjoyed the ability to create value while really controlling a identifiable risk that comes with the tenant piece on a single tenant deal. And, liked it to a point, and like the operators, that I had the opportunity about 2 years ago to join them full time. And that's where I am today.
I love that. And funny enough, you don't know this about me, but I used to work private equity, and we did small developments and new construction for the Texas area.
Very cool.
And I'm not saying I loved it. I understand the concept of it. For me, I just didn't love the rates we were at. I just didn't feel like they were competitive, and that's a whole nother conversation. But I'm telling you right now, to understand the debt markets and the money markets changed my entire life. It made me relook. Too many times we as people, let's say an operator, right? Just like you said it so perfectly. Too many people are trying to do too many things. And if you have a company, which my buddy runs one in Dallas, where they're debt equity brokers, then it allows you to say, I'm great at what I do. I go crush this food hall space, this multifamily space. You go do what you go do. That way the owner is worried about the day-to-day operations, and he's not flying around playing golf, shaking hands with people, trying to get people to raise money. And there is a symbiotic relationship that, once done correctly, is a very powerful mechanism.
Yeah. No, that's very true. I've always told people, I think you can afford to be a generalist, and I think you should be as an LP investor. However, you should be investing with specialists who have a very narrow focus on what they do, and they should have a track record and do it very well. And honestly, I would rather spread my investment capital personally across, say 5 different operators that each have a really tight niche and do it better than anyone else than, someone who claims to be, the best at multifamily across America.
And so what I'm doing right now, I have a couple friends that work in the markets. One runs the endowment fund, a $5 billion for UT. They've got a 50 deal. And I've got into this topic where I'm a mindset coach at Nature. So I love psychology, but it's behavioral investing studies, like understanding why people do what they do. And it's wild to me, the emotions that trigger people in their decisions. And you're 100% correct. And something I'm reading this morning, he said, "You're not special. Stop acting like that." and
that's when you go have another cup of coffee.
I love it because it's the truth. Because I realize how many times we want to be the person that comes in with the white horse.
Yep.
And ultimately, no matter what the market's doing, you have to be, what I'm trying to adopt is a neutral way of thinking, a stoic philosophy of, this is what the numbers say. And we know the markets that are going to dictate, like, look, is office and retail space going to change? Of course. But at the end of the day, it's also not going to change on some kind of context. I don't think people understand that. Yes, you have to be careful. But like you said, you have your money spread around with specialists in different markets. And then if one market's doing bad, this market's doing good. Because what's interesting? What I can't stand is when the pandemic happened, everybody said, all business is terrible. Well, hold on. My buddy runs a $10 million trucking business for grocery stores in California. He's crushing it. Like he's never been. So no, it's not. So if you're diversified over different sectors, then one market might be up, one market be down. Have you found that in your investing?
Oh, 100%. And, I think largely the type of tenants that we see in single tenant industrial, our focus has always been in core manufacturing, and largely B2B companies. So, companies normal consumers don't hear or touch, but, companies that make intermediate parts for, finished goods that consumers do buy. And these, just to use a couple examples, over the last year, a couple tenants that we bought, we've had everything from aerospace parts manufacturers that are building for, military and civilian airframes. We've had, we bought a piece of real estate, and the tenant actually created industrial mixers and dryers. I mean, imagine like a KitchenAid on your counter, but like 15 feet tall. And I mean, it mixes everything from, adhesives for, big, M3 and, everything from General Mills mixing cereal and the drying and the processing of these, goods that are required to, finally get products in boxes to consumers there. We bought a company that makes frozen pies and co-packs them for big white label grocers, to put, for example, the Walmart brand on their frozen pies. And, another company did high density foam end caps. And these are really, I mean, they're not like sexy end consumer facing products, but they have a huge, wide, diversified customer base. And they really, I mean, these are the gears of the economic engine. They're almost all deemed essential. And really across our portfolio, it's been a very strong year, both for the real estate side and for the tenants in the manufacturing space that have occupied it.
I'm starting to see a trend here about your personality. I realize that you're a curious soul. And being able to be maybe owner of said commercial space, but have the operator in your facility means that you get to look into these businesses and it keeps you intrigued and you get to learn new stuff. Am I wrong or right?
Oh, I mean, me personally, I nerd out on a huge level. I just quick aside, I was on out in the Midwest last week and doing a couple property tours. And two of the pieces of real estate we looked at, one is tenanted by a big auto parts manufacturer. They make these basically fluid transfer assemblies, which sounds like, it really, most people can't even picture what that looks like. But just imagine like tubes and pumps and really anything that's liquid that moves from one part of a car to another, and these are engine part intermediaries. But it was fascinating to me to see these, giant, machines that are crimping and twisting in exactly the way they need to fit in with all these other parts for the engine spec. And, they're selling to 15 or 20, brand name auto manufacturers. This other company made smoked meats, everything from jerkies to meat sticks to, even like smoked organic vegan mushrooms. And it was wild just to see the processing rooms and, each stage and all the steps that go into it. And I love just, even though we're not investing directly in that company, we are, becoming a part of that company's future by, owning the real estate that they operate and succeed in. So, to me, that the two are married hand in hand.
Yeah. And it keeps you intrigued. It keeps you invested. It keeps you occupied, and I think this theme keeps coming up in the last couple of weeks. I just got off a call with a couple of investors. For me, as I get older, I gravitate farther and farther away from the sexy stuff because it's the stuff that needs, the meeting with the title rep is not as cool as meeting with the luxury broker. But the title rep actually does deals and might have a ton of deals for you. The meeting with the debt and equity broker doesn't sound cool on the surface, but he's the one controlling $30-40 million deals.
That's true. Once you figure that piece out, it helps your time be a lot more efficient down the road, right?
100%. And so I haven't had a lot of commercial guys on the podcast from a pure nuts and bolts scenario. Real quick, what do you do for Matt Capno personally?
What exactly is it that you do here?
Well, and like no, like I know what you did at the previous company, but when they
Sure.
brought you on, what do you
Yeah,
do
no,
for?
of course. So I'm the COO at Mag Capital.
Okay.
I oversee both, kind of internal operations, but primarily the capital markets side.
Okay.
So really, we have basically everything from current investor management to growing our group of investors that invest in our deals. We don't do funds. Everything's deal by deal basis, and almost all of the capital we raise is kind of internal from a group of investors that we've had.
So in essence, not a syndicated deal or kind of in a structure.
Most are syndicated, correct?
Okay, so syndicated deal to deal, not a huge fund where you're always
Correct.
having to feed the beast. Okay,
Yep.
perfect. And what I hear a lot of people, I was listening to a big developer on a call, and he was saying that the same deal that they tried to go negotiate in March, they actually got a better location for a better deal because of COVID, and they're locked in with a better rate. And so what do you think the aspects of somebody, let's say in a single family space or just a multifamily guy that wants to get into the commercial retail space, what do you think the aspects of the business is the most misunderstood part of the business that people don't pay attention to?
That's a great question. I think when you come in as an LP, one of the big things is you are truly passive in a way that, I think being a single family investor, you're like, well, I got property management, so it's passive, but not really, right? I mean, you're still putting your time, you're still overseeing that property management. There's still a lot of, kind of direct or indirect decisions you're making on that property. I think when you're coming in on the commercial side, you're truly removing yourself in a way that, depends what your objectives are, but it's beneficial to a lot of folks if they're trying to optimize for time. However, the trade-off is you have a lot less direct control on, how that ship is being steered. And I think on the flip side, that makes it even, ever so more important that you have a much higher level of trust with the, sponsors who are running that project. And, you asked on, really what is most misunderstood. I think, really it's easy to kind of fall into commercial real estate that people think they understand or are more familiar with. And what I've found is people initially gravitate toward commercial real estate that they experience on a personal level. So for example, hey, most people have lived in an apartment or have family members who have at some point, right? So, hey, maybe I should start with multifamily. I get that, right? Or, hey, I shop, down the road at a local strip mall. Hey, those are retail stores. I think I understand that. But really, I mean, you should remove the, kind of personal element of it. And then when you start looking at kind of the nuts and bolts, you realize some of the commercial real estate that maybe you don't have direct exposure to actually tends to be, either a lower risk profile or a more diversified risk profile than, what it is that's within eyeshot. And so that's, I tell people to kind of do your homework, do a lot of recommendations. I think that's the best way personally to pick the sponsors you invest with. It's just, ask around and start going, hey, give me a list of the top 3 people that you've invested with. And that's a great short list to start doing homework as opposed to just, hitting the internet and hoping you hit gold.
Well, what changed my life was I have a friend who runs $1 billion private equity fund. He's a developer. They have a couple of different aspects, big, large scale projects or hotels or whatever. And I have a separate company that manages Airbnbs for investors for years.
Okay.
And we can get good returns and all that stuff like that. And I went to him and he said, I got 4 new townhomes in the middle of San Antonio. I said, dude, I can offer you like $3,000 over your mortgage. And he goes, I don't care. And I was like,
Really?
what? He goes, we have to make sure that our debt is secured so we can refinance these on leases, like actual stuff. Right. And so I look at that from what people don't understand about a retail space is that these long-term leases are the currency. And that's why it's so valued so high. And it made me realize that all money is not created equal.
That's absolutely true.
And it changed my life because when you're young and you're getting in this game, you think, oh, well, the biggest return matters. Mm-hmm. No.
Nope.
the most committed money for the longest period of time matters.
Yeah. No, that's a very good point. I mean, the way we approach, just to use an example within the single tenant space, right? You have some folks who will pursue what I call an end of lease risk, and they might take on a property that say has 3 to 5 years left on a long-term lease. And, they're going to come in and they can probably offer higher returns. However, you as an investor and as an ownership group, that group knows with a high degree of certainty, they're going to have to go through a releasing event. And there's a huge amount of uncertainty with that. A, are they going to release? B, are they going to ask for extra, provisions, TIs? There's a lot of things that may happen that you can't necessarily control. You might think you know where it's going to go, but at the end of the day, 3 to 5 years, a lot can change. Whereas, you might say, hey, I'm willing to take 1 or 2, points lower return, but I want to be on the front side of a lease, say that the first owner of a 20-year lease. And now I know at a high degree of certainty, I'm getting that cash flow and I never have to go through that uncertainty of a releasing event. And, we're selling that asset still, maybe we buy it with 20 years, we sell it with 15 years left. And that's, almost guaranteed we don't have to worry about any sort of releasing considerations. And that goes to the next buyer who's willing to take on a little more risk at that point.
And so from my understanding, because I just had one of my coaching clients buy a retail space, kind of walk me through it. I'm going to lay something out for you. If you're buying, let's say, distressed retail space, say you have 4 tenants, say you have leases that are up, you go in, fix the space, you resecure, let's say they all on 15 or 20-year leases. That is secured long-term tenant, and you've raised the prices, you fix the space. In a perfect scenario, do y'all look at it as it would be great to sell in year 5 because the buyer still has 10 years of leases? And if, let's say, those leases were only 5 years and you went to sell at year 5, you're not going to get the most amount of money if those leases are going up that month or the next year, correct?
Yeah. There's 3 components on how you value these, right? You have cash flow, how much cash is coming in. You have the lease, which governs that cash flow and governs how long that cash flow is guaranteed. And then you have the credit of the tenant. And that third piece, I think, is easy to overlook because it's hard to quantify. And that, to realize, hey, this quote unquote guaranteed income stream is only as good as the quality of the credit of the tenant who's occupying the space. And so really, putting a value on how strong that tenant is immensely important to really understand the true risk of these. So, to use your retail example, if you have, just in the news lately is GameStop. I don't want to throw them under the bus, but, there's stocks been all over the place. But, on a fundamental basis, GameStop, I would say, even if I have a 10-year lease with GameStop, I'm a little concerned, right? I mean, there's a high likelihood that their business model is going to shift before the end of my 10-year lease. So I'm looking at, hey, would I rather have, a Walmart that has huge pockets and profitability, or am I willing to roll the dice maybe with a local, mom and pop, either individual store or a small chain, in a particular metro, and really, have the understanding of how secure is this particular lease that I'm setting up along with those cash flow streams. I think that, to me, that's where I would start. And then the second piece, all things being equal, if we determine they're all, fairly safe bets from a credit standpoint, then you look at those leases, and the leases they're kind of tough, because you on one side, you want to maximize value for yourself to increase price to sell. However, you can kind of incentivize a buyer if there's more bumps, kind of in line down the road. So, it's basically like how much of the value do I want to capture, and how much of the value do I want to leave left to the next buyer to make that an attractive sale. So, I think that's the balance that, if you lean too far one way or the other, you're either leaving money on the table for yourself or them. And so to try to find that balance, really it depends asset type by asset type, but I think that's where the finesse comes in.
I love it. And then to flip it on its head, you as a debt and equity broker that's pairing up with the operator, what do you want to see from a company to fill up your space that you feel very confident about them stepping into whatever asset class you're working on with them?
Yeah. So hold on. So just to make sure I'm following you, you're saying if I'm like
a lot of guys that I know have, like, let's say, a brick and mortar or digital business where they're seeing opportunity. So I'll give you, I'm an analogy guy. I spend a lot of time in the restaurant business. So Valentine's Day is a very interesting day to me, and I call it the Chili's effect. So if you go to Chili's on a regular basis and it's Valentine's, you might go to Cheesecake Factory on Valentine's this time.
Okay.
And then if you go to Cheesecake Factory, you might go to Ruth's Chris Steak. So
got it.
There's space
up a level.
There's space operating where retail space, maybe you can move into a better location, get out of your thing. But there's a scale to operating a business in brick and mortar. When you're putting your money down, what do you want to see from an operator? Is it all about, are they growing at the right pace, cash flow?
Sure.
Like, are you looking at their cash flow and saying they have enough money to pay for this?
So we actually, there's two types of tenants. You have credit tenants and sub credit tenants, and that differentiation is important. So the first, we'll start with the better known credit tenants, usually $100 million or more in revenue, oftentimes publicly traded. And one of the common things they usually have is an outside credit agency giving them a credit score. So you might have, an S&P or a Moody's. They are, BBB minus or, AA minus, whatever it might be. And that gives you at least some objective measure to understand the risk of that tenant. And that score is going to incorporate everything from, their balance sheet, their financial, their historic financial summaries, the projected, what the next few years look like, their debt to EBITDA ratios, quick margins. I mean, really all these financial metrics sort of squeezed together into a single score. What we play in, and honestly, what the majority of tenants fall in are sub-investment grade, and those don't have an outside credit agency. So to really understand that, you kind of have to do the work yourself. And, what we do, there's independent shops that will come in and kind of create a report for you. We do this full time. So we actually have a, 2 or 3 guys internally who do nothing but run credit and build credit reports for the, potential tenants we're looking at. And really, so they're looking at those things we talked about there. What kind of debt do they look at? But what's interesting, the way we buy real estate is we're typically doing sale leaseback. So we are buying the real estate from a company that owns their property as well. And then we're turning around and simultaneously leasing it back to them. And so when that happens, they're getting a big influx of cash from the sale of that property as they become a renter. So we will build a scenario. Hey, historically, this has been their basically financial picture. Afterwards, they'll interview the C-suite and go, hey, how are you going to use this money? Are you paying off the investors and, basically is the money evaporating, or are you using this money to reinvest in the company? Are you paying down corporate debt? Are you reinvesting in, capital improvements, new manufacturing lines, new headcount? Because it's important to know, hey, where is that value going? And, the majority of good operators will say, hey, at least the majority of this cash, we want to invest back in the business. And we want to, basically lean out the business, make it stronger. And that's, kind of their driving reason for a sale leaseback. But yeah, to be able to understand that picture is super important.
Yeah. I mean, this is like right up in my wheelhouse. I wish I could go back in my life. I know I still have plenty of my life, but I wish I could go back in life and be an M&A specialist. I just think I think there's going to be a ton of opportunities. One of the things that I noticed is there's a lot of people that are good at what they do, but yet they may not be good at marketing or growing their business. Like you have a great plumber, but he's not a salesman, but he's a great plumber. Sure. And so I think there's going to be a lot of opportunities to pick up businesses or properties in a distressed avenue where you can put your systems on the business and really create, whether you hold on to it or sell it. And that's what I think is coming. Yeah. Not already coming down the pipeline. Yeah.
Yeah. Especially if you if you had the ability to partner with someone who's great at identifying distressed, kind of value pickups. Mm-hmm. I mean, right now there's probably a flood of good opportunities on the, mm-hmm. PE space there to, pick up some real winners that maybe just need a little bit of, life support capital to keep mm-hmm. them moving, but still have a quality business model that, likely will kind of resume here in the next 6 to 12 months.
100%. And I was looking at your website and you're kind of invested in, it seems like a lot of different states, right? when you're going into a place, let's say you haven't done business before, what do you, because I love to study human movement and kind of buying habits. What are the indicators, the main ones that you're looking at when you're looking to get into, let's say, a Louisville or a Denver or a Newmarket and stuff like that?
Yeah. I mean, we most of our acquisition centers on, I would say, cap rate parameters first. That cap rate incorporates a lot of things, but one thing it should ideally incorporate is risk, right? So, higher cap rate indicates a higher degree of risk, lower cap rate on the opposite end. And so, we usually shop between about a 7 and 8.5. That's our buying criteria. And when we come in, there's two main functions that will kind of make up that overall risk profile. And one is the strength of tenant. And then the second is the quality and location of real estate. And so on the single tenant, especially in the industrial side, we differ, say, from multifamily, where, multifamily is all about the metro and the demographics. And, hey, we're trying to do a value add. Here's why we think this sub-market can support, higher rents and better occupancy. For the industrial side, we don't really care so much about that. We're coming in 100% occupancy from day one. And, we might say, hey, I'm willing to take kind of a great piece of real estate, maybe, 20 or 30 miles outside of the nearest big town, but it has a powerhouse company. They've been super profitable the last 5 or 10 years, great profitability margins. And that could offset. Or I might say, hey, I'm taking an okay credit tenant, but on the flip side, that the real estate is right in, downtown Des Moines or, wherever it might be, Phoenix, one of these spots that the location kind of offsets the, maybe more marginal level of credit. And again, we don't buy any low credit stuff, but, it kind of ranges between great and I would say average. And those are kind of two levers you can play with to kind of find a happy medium to say, hey, I'm willing to go tertiary with a stronger tenant or vice versa. And that's kind of what we look for. And you talked about where we start looking. That kind of sweet spot usually for us falls in the Midwest. We're buying Texas, Iowa, Nebraska, Oklahoma, Indiana. And really for two functions. One is, you just typically get better cap rates out there across the board compared to coastal spots. And the second is from a manufacturing level, being geographically central just makes sense. You're saving on shipping costs, especially if your addressable market is coast to coast.
Yeah, we're about to launch something in the next couple of months where it's going to be expanded across the United States. And it's interesting when you start like digging into shipping costs and everything. It's you understand why an Amazon, starts putting this facility there and there, yes. And there's strategic logistics point of views of why the business is operating in that avenue. And what's interesting is I think if you watch what's happened, technology wise is changing a lot of the way people do business. So I've never understood, if you're trying to grow your business and you don't have the capital necessary, like why wouldn't you just move it to a place where your overall nut on the month is a quarter of what it would be?
Yep.
It doesn't make sense to me. I get it. You can fall in love with something, but it's going to give you a lot more runway, right?
Yeah. Yep. And give you time to kind of achieve your goal of, whatever your output or profitability margins look like.
For sure. And I noticed that your buy is kind of like a food service. Like, I would just love to hear, I know, like, literally I could ask you this and Friday it's going to change because the market's moving so quick. But just kind of, if you could give a $30,000 view on, do y'all play in the food business? I spent 20 years in there, so I have a different point of view of it. Kind of what's happened. It's definitely been annihilated to an extent.
We have, for food production, currently under ownership, we have a property in Fresno that makes organic baby food. And they've been really a fantastic tenant. Those guys, they make their own brand and also co-pack for other brands, but they do basically, fruit and vegetable mashing and canning and, basically just put on another company's label. co-packers actually tend to be really profitable and they're nice because they have a much more diversified customer basis than, someone who does it all under one label. And then we also have, I think I mentioned a cold storage industrial facility up in Rochester that makes frozen pies. And they do, a mix of like pie tins and pie shells and full done pies. And they make them, manufacture them, some under their own label, some under, large grocers. And those two. Oh, and then lastly, the smokehouse that I mentioned, that one, if that one comes to fruition, that will be our third, basically food industry tenant. But yeah, I find if they're broad enough, if they're high enough up the food chain, if you will, where they have a lot of different addressable customers and markets, we like them as a tenant. I think the more kind of downstream you get, the more, closer to the consumer. From our perspective, it kind of concentrates a little bit of the risk on that side. That we tend to maybe steer away from that level and try to go more in the higher up, back a few stages on the co-packing side.
Yeah, another analogy, the farther you get up the food chain as a chef, the further you get away from the kitchen.
Exactly. I like that.
I like the businesses that are as far away from the kitchen as possible.
Exactly, right?
Yeah. So we're going to switch gears because just selfishly, travel is all I care about.
All right.
I was looking at 50 acres for a client here in Texas, and Austin has taught me to never judge a book by its cover. They might be a multimillionaire and wear flip-flops and have a black AMX and wear sweatpants. It's just Austin. I'm sure San Francisco's the same way. But I met this country dude. He was ex-military. He was a aviator, trick pilot. And he's cool. They had he had like 4,000 acres, 50 houses. Like he was like, yeah, I've been to 274 countries. And he told me, he's a master diver. He told me something. He said, listen, I traveled the world. He said, this trip was everything. He said he went to Kenya during migration and took a hot air balloon up as the sun was coming up. And that's been the picture in my head of something. And so on your travels, just pick maybe one or two. I know it's hard, but like this experience that you're like, because what I love about, and I see it in life and in general, I think too many times people focus on the regular, and I like to get lost. Like when I'm traveling, maybe find a city that nobody's heard of or something like that. So is there a city or a place that happened to you?
Oh man. One spot that stands out that I really loved was a place called Kep, and it's a crap.
Is that in Croatia?
Cambodia.
Cambodia.
So,
okay.
Kep, yeah, KEP, and it's like a crabbing sector, kind of on the southern shores of Cambodia. And I love Cambodia. I used to live in Japan, so I was in Tokyo for about 4 years with the service. But it was great experience and got to see a lot of Asia. And, I feel like a lot of people go to Thailand when they want, Southeast Asia beaches. And don't get me wrong, they're beautiful there, right? But I feel like Cambodia is something special to me just because I feel like the beauty is there, if not even better. And, you have this kind of surreal, still it's a bit untouched. And especially when you dive into the history a little bit, with the Khmer Rouge, I mean, really they only, quote unquote, opened for tourism, for visitors to come in, I mean, kind of in the early 2000s, 03, 04, 05, kind of when the last of the Khmer Rouge was leaving and they kind of changed their stance. So there's this whole part of Cambodia that really is very new to other people even wanting to go visit. And I just found, I mean, really from a people interaction perspective, I mean, I just had the opportunity. I remember just walking along the beach there and these guys were there and they're like, oh, and, we started talking about crab and, kind of, they had some broken English and they took me out on this crab trawler. I was literally just on the spot, and we came, we drug up crab. I mean, it was literally just the most random, surreal experience. They had this Cambodian liqueur that we were pouring.
Yeah, dude.
by the end of it, we're all, fairly hammered, like eating crab on the boat. I mean, it was wild, but just this, kind of organic experience that, you never get in more, seasoned tourist areas. And I kind of love just the, the unexpected like that you can really only get when you deviate outside of, name brand locations.
I had the same experience, same situation, Airbnb, Burgundy, France, small 100 square feet next to the most expensive grapes in the world. Wow. And we're sitting there at breakfast. They don't speak English. I'm like using the translator. He looks at me and he goes, "You sold wine for 20 years. He's like, "You seem to learn. How many tastings do you have?" I said, "None." You can't get a tasting here. And he goes, "Oh, well, my buddy makes wine. We can go to his private vineyard." And I got up right at 6 a.m. I was like, let's go. And he's like, no. He's like 6 o'clock tonight. So we drive down. He's French. So long story short, the Americans gave the French the bacteria that killed, they lost like 80% of their vineyards, but America came up with the bacteria to kill the bug that was killing their stuff.
Oh, I didn't realize that.
So he loves Americans. So I walked in and he goes, "Viva America!" And I love America. And so none of his wine has ever seen the States. And we sat in his personal cellar in his basement drinking 1970-year-old Pinot Noir. And I'm thinking to myself, like, this can't be real.
Such a cool experience. That was just from an Airbnb?
Airbnb, $40 a night. Like that happened. You can't pay for that experience. We had another one happen in Chablis, same thing. The number one, she was the first woman ever to make Chardonnay Chablis in the world.
Wow.
And we were at her private house and she busted out a bottle that had no label and just like a crayon written on it. Now I don't drink anymore. That's a whole nother story. But do you drink wine? You like wine?
I do, yeah.
I'm going to send you a podcast when we get off. So my buddy, Christopher Lockhead, who lives in Santa Cruz, huge marketer, the godfather of credit cards, he interviewed a guy and he's building out wine vineyards in Nepal. It's the last frontier, and it's up the elevation, and the different vineyards goes from 0 to 14,000. They're playing with everything. Dude, it's like the last frontier of wine. He said it's just like this magical area that nobody knows about, and he's playing with the different elevations. It's a very interesting episode.
That's incredible. I would love to hear it. Yeah,
I love stuff like that. And so we're wrapping up the interview. If people want to find out more about Mag Capital and all that stuff, how do they do that?
Yeah. Our website is magcp.com. Or, I'm really responsive. Just shoot me a note. I'd love to hear, feedback, any questions. Happy to talk about, investments in our space. You can reach me at Neil, Neil, like the astronaut, at magcp.com. So Neil at magcp.com.
Well, I appreciate it, guys. If you like this episode, make sure you send it out to your friends, guys, and we'll see you next time.
Thanks so much, Austin.
Thank you for listening to Construct Your Life with Austin Linney. If you enjoyed this episode, be sure to rate, review, subscribe, and pay it forward by sharing with a friend. Most importantly, take this opportunity to start constructing your life by taking immediate action on what you learned. For show notes, resources, and more information on one-on-one coaching with Austin, visit constructyourlifepodcast.com.